With the 2020 election exploded, many investors are asking themselves, what's next? 4 years ahead become uncertain. On top of that, the nation remains divided, so it's now more critical than ever for traders to look for long-term stocks that offer reasonable returns without too much risk. Make sure to watch until the end. You won't be disappointed after securing your investments in the stocks presented on our list. Today we discuss millionaire maker stocks, high-potential companies with enough stability to guarantee a significant position, a 10% position in a security that increases 50 times. After all, we'll return a $200,000 portfolio into a $1.2 million. What about moonshot investments, you think? It's always fun to discover the next Tesla. But these entertaining investments can also go to zero real quick, which means most investors aren't placing more than 1% of their portfolio into a single name. And as for the mega-cap blue chips, like Apple, those companies are already so immense that even a large stake won't grow your portfolio by much. That's why millionaire maker companies are so vital for investors. So with the election now passing, here are 5 of our favorite long-term stocks that should do well despite the political environment. Let's start our top with Lyft. LYFT. Because all of the confusion caused by the presidential election, it's easy to have overlooked different voting matters. California's Proposition 22. On election day, the state's voters gave a ballot proposal allowing ride-hailing companies to classify workers as contractors rather than full-time employees. This is a huge win-win for Lyft. That's because it builds a roadmap for the company and its opponents to build out a gig economy workforce. Following the new rules, workers now have access to a middle-path employment status that gives part-timers secured minimum payments, healthcare, occupational insurance, and life insurance benefits. The news comes at a middle moment of Lyft. Unlike its bigger competitors, Lyft stayed in ride-hailing rather than diversifying into food delivery. That meant its ride-sharing business endured far more during the pandemic. Revenue narrowed from $867 million within the second quarter of 2019 to merely $339 million in quarter 2 of 2020. Today, shares are falling over 50% since the company's first public offering (IPO) in 2019. That offers investors a golden opportunity to invest in an up-and-coming company. Analysts expect Lyft to join positive EBITDA in 2022 and for the general market to raise 8-fold to $285 billion by 2030. Since the novel pandemic subsides, that means that just $12 billion in the market capitalization, Lyft stock looks like a real steal out of all the long-term stocks. Moving on next, General Electric, GE. General Electric, which makes much of its profit from jet engines and medical imaging devices, has also been hit hard by the pandemic. With fewer aircraft in service, demand for its lucrative spare parts division wiped up. And to aggregate GE's COVID-19 woes, hospitals also put off adding new MRI and other scanning machines as the novel pandemic rage. But don't assume these short-term problems will last forever. That's because after years of shedding underperforming shares, GE finally has a healthy mix of white moat businesses. The company holds a vital portion of the world's industry in jet engines. This highly profitable aviation business generated 21% returns in 2019. As for healthcare, GE stock gained 20% returns in 2019. The legacy industrial company has also been following its usual power segment with renewable energy. The company presents onshore and offshore wind, blades, hydro, and grid resolutions. Ultimately, at 4x EV to EBITDA, GE stock is priced very low. That makes General Electric one of the long-lasting stocks sharp for a robust 2021 recovery, no matter the economic uncertainty. Following next, Etsy, ETSY. Etsy, a famous US e-commerce site, has been an enormous winner in 2020. Shares have been rocketed 185% year-to-date as both buyers and sellers have come to the place for custom, handmade, and vintage goods. However, the company can track its success back even further before the pandemic. Etsy has grown earnings and been profitable since 2016. Its e-commerce platform operates in a worthy cycle. More sellers coming onto the site also encourages more buyers and vice versa. Moreover, Etsy was quick to compete with eBay on ease of use. In 2016, the company got Blackbird Technologies to add AI-driven product support. In 2019, Etsy's habitual buyers jumped by 23%. and the company has more place to grow. With an $18 billion business value, Etsy is only 50% the size of rival eBay. The company, of course, will have to manage growing pains. Its established take rate and angered sellers over changes its advertising policies. But if the company can continue developing its product offerings, it could convert into the next e-commerce success. That makes Etsy stock one of the most significant promising long-term stocks on the market. Going forward, SolarEdge, SEDG. With so many money-losing solar companies on stocks, it's hard for investors to know where to start. For example, photovoltaic or PV panel makers like First Solar compete against Chinese makers rock-bottom prices. Contrastingly, solar leasing companies like Sunrun waste money on debt service. That's where SolarEdge enters the stage, a specialty provider of power optimizers, solar inverters and monitoring systems for PV arrays. These are natural components to getting the most out of solar panels. And that supported SolarEdge churn out profits year after year. The company has finally made money since 2015. It now earns a 14% return on invested capital, light years ahead of other solar players. SEDG's stock has also played well, returning over 1,200% in the past 5 years. What's more, following the International Energy Association, solar power generation will be the main driver of growth. It's renewable energy heading towards 2040. Countries look to decrease their dependence on fossil fuel. That only suggests that demand for SolarEdge's products will proceed to grow. Like most solar companies and compared to other long-term stocks, SEDG isn't that cheap. At the moment, it trades for about 57 times EV to EBITDA. But if the company can keep rolling the wave of solar investment growth, its earnings will skyrocket. And finally, the desert, Splunk, SPLK. Rounding out my top lasting stocks for 2021 is Splunk, a rapidly growing software company. The San Francisco-based firm practices analyzing machine-generated big data and has been roughly 50% annual recurring revenue or AAR growth through second quarter this year. Why such swift growth? Splunk's underlying market is growing fast. According to the Gartner's research, 25 billion devices are already attached to the internet. Analysts expect that figure to nearly double by 2025. And that's where the Splunk comes in. The company's data-to-everything platform supports customers to gather and manage data from connected devices. It's a massive growth market with companies like Nvidia and Tesla fighting for their space shares. There's just one drawback to Splunk. It isn't profitable yet. To grow its customer base, the company pays much of its profits on sales and marketing. The numbers should decrease over time, but as existing customers renew their contracts, long-term shareholders investors in SPLK stock should expect positive EBITDA by the fiscal year 2022. So what do you think? Which stock would you prefer to invest in 2021? Will you wait for the new year to start, or are you already searching for a platform to support? Leave your opinion in the comments below. If you haven't already hit the like button, do it now. Likes help grow the channel. Don't forget to subscribe and hit the notification bell to receive more video content. We hope you enjoyed today's video. Thank you for being at Luxury Sensei and see you in our next video.